Often when I speak to a founder of a startup or an owner of a private company, they'll ask me, somewhat embarrassed, what does D&O insurance really cover? Look, I get it. Insurance is confusing. There's no need to be sheepish or feel silly asking questions. Truly, there are no dumb questions when it comes to insurance, and D&O is no exception. Hi, I'm Gordon Coyle, and in this video, I'm hoping to break down into plain English what D&O insurance is all about, who it covers, what it covers, and why your board is anxious to be insured. First, like a lot of insurance terms and policies, there are multiple names for D&O. It's really known as Directors and Officers Liability Insurance, but sometimes it's also called Management Liability Insurance, and D&O is just an abbreviation. So the first question is who does D&O insurance protect? Yes, simply directors and officers of a company, whether that's a public or private company. But it'll also protect owners, managers, and other decision makers in a company in their capacity as decision makers. And that's the crux of D&O. It's basically coverage for lawsuits which may arise from poor decisions. Think of it as malpractice for decision makers. Technically, the policy says that it covers the insureds for claims which arise from wrongful acts, and then goes on to define wrongful acts as an actual or alleged act, error, omission, misstatement, misleading statement, or breach of duty. Question: why does a company or its decision makers need or want D&O insurance? First, claims from wrongful acts, like I just described, are not covered under a business owner's policy, a company's general liability policy, or their umbrella policy. For claims like this, you need a D&O policy to protect the company's decision makers. Second, and maybe more importantly, is that D&O related lawsuits commonly will name individual decision makers, meaning the owners or directors, managers, or officers, as a defendant personally. And this means that personal assets are on the line, and that drives many board members to really want D&O insurance before they agree to sit on a board. Question: where do most D&O claims originate from? Claims can come from shareholders, creditors, lenders, banks, regulators, competitors, and others. But there are many reasons why private companies purchase D&O coverage. Here are just a few more reasons. First, it helps them attract new directors to their boards. Second, if you're attracting venture capital, many VC firms will require D&O prior to their investment in your company. Third is bankruptcy. When a corporation becomes insolvent, D&O insurance is what stands between creditors or bankruptcy trustees and the personal assets of directors and officers. Fourth, shareholder suits. Yes, even private companies can face shareholder lawsuits, and it only takes one disgruntled shareholder to threaten or bring a suit. Fifth, regulatory exposures. Most private companies are subject to some regulatory authority, and defending against a government enforcement action may be expensive. D&O may cover these costs depending on the situation. Number 6, if you're planning on bringing your company public at some point, having D&O while you're private will help protect you through the transition to becoming a public company. 7th, the same is true if you think and may be involved in any merger or acquisition activity. Whether as a buyer or seller, D&O is critical to protecting decision makers for the representations and other statements they make in negotiations. Question: what's not covered? There are a lot of exclusions, but the biggest point to understand here and what confuses a lot of people is that bodily injury and property damage are not covered in a D&O policy. In fact, they're excluded since that's better insured under the company's general liability policy. Other exclusions include things like intentional frauds and insured versus insured actions. Question: what does D&O insurance cost? That really depends on the size of the company, the industry, the location, and the company's financial situation, and more underwriting. In order to get a firm quote, an application is usually required with several attachments like financial statements, business plans for startups, and claims history. Question: what coverages can be purchased along with D&O? When a private company purchases D&O, it's common to also include 2 or more additional coverage parts. Typically, they will include employment practice liability, commonly known as EPLI, and fiduciary liability. EPL will cover claims which arise from wrongful employment acts such as discrimination, harassment, or wrongful termination. You can see more about that here. Fiduciary liability will cover claims which arise from ERISA violations and is intended to protect trustees of benefit plans such as a 401k, and you can see more about that here. When 2 or 3 policy forms are combined with D&O, it's known as a management liability policy or package. Other lines of business that can be combined with D&O are crime, cyber, kidnap and ransom, and more. Here's the bottom line. D&O is critically important for not just public companies, because private firms and their decision makers need protection as well. Have other questions? Interested in discussing this further? Looking for options? Why not contact me and let's start a conversation and see if we're a good fit for your firm. And before you go, please click the subscribe button below and like this video. Thanks.